Hello, I'm Billy Schmall, Vice President of Investment Information at Alamo Capital. Thank you for joining us today as we discuss the various municipal bond insurance companies in the market, their history, and their ability to fulfill their obligations. Let's start with Build America Mutual, or BAM. Established in July 2012, Build America Mutual is the first mutual municipal bond insurance company. It is owned and operated by cities, states, and other municipal entities for their benefit. They have strict underwriting guidelines which only allow them to insure relatively low-risk entities. BAM prides itself in putting policyholders first, having unprecedented transparency, and having no exposure to Puerto Rico. Their $3 billion portfolio has claims-paying ability of about $600 million. Berkshire Hathaway Assurance Corporation, or BHAC, was established in December 2007. Berkshire Hathaway created BHAC to insure the debt of state and local governments. BHAC is owned by Berkshire subsidiaries Columbia Insurance Company and National Indemnity Company, who recently renewed a 5-year corporate guarantee of BHAC's obligations. The ratings reflect BHAC's strong capital position, though they're offset by BHAC's limited activity and modest exposure to issuers such as Detroit and Puerto Rico. Assured Guarantee and their affiliates such as AGC, AGM, and MAC are a multi-line insurer covering U.S. public finance, global infrastructure finance, global structured finance, reinsurance, and consulting services. They are the leading provider of municipal bond insurance in the United States, guaranteeing bonds secured by tax revenues, enterprise revenues, and essential service projects and services. They are viewed as the leader in the financial guarantee sector with a strong capital profile. However, they do have exposure to both Detroit in the amount of $169 million and Puerto Rico in the amount of $5.7 billion. They have a combined portfolio of approximately $472 billion, with claims-paying ability of about $11.6 billion. National Public Finance Guarantee is a subsidiary of holding company MBIA, a multi-line insurer focused on asset management and other specialized financial services. National is a monoline insurer with a strong capital profile and has effectively reduced risk as their portfolio amortizes. They are not currently underwriting new policies, which adversely impacts their ability to diversify their revenue streams. They continue to face pressure from exposure to Detroit in the amount of $88 million and Puerto Rico in the amount of $5.19 billion. Their $324 billion portfolio has claims-paying resources of about $5.7 billion. Radian consists of a group of separately capitalized companies providing credit enhancement for mortgages, public finance, asset-backed securities, structured products, and reinsurance. After coming under a great deal of distress in the economic downturn, Radian began seeking waivers on claims in late 2011. Radian later commuted a substantial portion of their municipal bond business to Assured Guarantee in January 2012. The move helped Radian improve their capital position and effectively seeded its public finance business in order to focus on mortgage insurance. They continue running off their portfolio of about $28 billion, with claims-paying ability of about $1.7 billion. Syncora Holdings, formerly XLCA, was established in 2000 as a holding company providing financial guarantee insurance and credit enhancement for international and domestic debt markets. In June of 2008, the company reported negative statutory capital, creating uncertainty about their ability to execute on claims. By July of 2008, the municipal bond division was commuted to Syncora Holdings, allowing the unit to remain solvent. As claims piled up, the company was forced to restructure in July of 2009, relieving the company of approximately $6 billion in losses and served as protection for municipal bond policyholders. Today they operate to run off the portfolio. They have about $65 billion in exposure, including $366 million in exposure to Detroit and about $828 million in exposure to Puerto Rico, with claims-paying ability of about $2.18 billion. Financial Guarantee Insurance Company, or FGIC, was established in 1983 as a monoline bond insurance company. In 2003, they were acquired by a group that included PMI, Blackstone, Cyprus, and CIBC, upon which they expanded their business lines. By 2008, the claims associated with the expanded business lines impaired their ability to underwrite new policies. And in November 2009, the New York Insurance Department ordered FGIC to suspend payments on claims. FGIC began the process of rehabilitation in June of 2012. In August of 2013, FGIC emerged under the first amended plan of rehabilitation, dated June of 2013, and now conducts business accordingly. Their total exposure is approximately $47 billion, with limited claims paying ability. Most of their higher quality municipal exposure was conveyed to National, and they have about $1.44 billion in exposure to Detroit and about $1.1 billion in exposure to Puerto Rico. CIFG is a global financial guarantee company established in May of 2002, providing monoline insurance for public finance, project finance, and structured finance. As the economic downturn set in, CIFG experienced excessive claims associated with its structured finance division and opted to have its credit rating removed. They successfully unloaded a substantial portion of their credit default swap exposure in September of 2008 and unloaded $13 billion of municipal bond exposure to Assured Guarantee in November 2008. Today, the group operates to run off its portfolio with about $20 billion in exposure and $400 million in claims paying ability. Ambac Financial is a holding company providing financial guarantees to public and private sector clients globally. Ambac was originally created in 1971 to guarantee the principal and interest of municipal debt, and diversified to other business lines starting in about 1993 to include mortgages, credit cards, autos, and credit default swaps. By late 2008, the economic downturn set in, and Ambac began facing significant claims by their newer business lines. In March of 2010, they placed claims in a segregated account that, in their words, presented a serious financial hazard. After a struggle meeting its obligations, the holding company filed for Chapter 11 bankruptcy protection in November of 2010. A rehabilitation plan was accepted in January 2011, and they emerged from bankruptcy in May of 2013. Ambac has stated they intend to stand behind their municipal bond guarantees, with the exception of $26 billion in the segregated account, subject to change. They have $210 billion in liabilities, including $171 million in Detroit and about $2.58 billion in Puerto Rico, with approximately $2.5 billion in claims paying ability. As you can see, many of the insurance companies underwent a great deal of stress during the economic downturn, but some of the newer entrants to the market and those that chose not to diversify into more exotic financial guarantees still have adequate claims paying ability. For now, most municipal bond insurance companies continue to stand behind their obligations. Many of the insurer ratings reflect the low historical probability of default among municipal bonds. Likewise, many of the insurers could come under future stress from obligations associated with distressed issuers such as Detroit and Puerto Rico. While municipal bond insurance is generally viewed as a credit positive, we encourage clients to ensure that the underlying credit quality of a given issuer is in line with their risk tolerance and not to compromise credit quality because a given bond has a form of credit support. For more information, please call us at 877-68-ALAMO. You may email us at information@alamocapital.com or visit us online at alamocapital.com. On behalf of Alamo Capital, thank you for joining us today.